going, everyone? This is an adjustment trade alert for Nike, ticker symbol NKE. In early January, I initially sold the 135 put here, and I collected a $1.15 credit. And slowly but surely, this has moved against me. And finally, yesterday, it breached my break even, and so I needed to roll the trade to the next month. So to roll this trade, I had to buy this same position back here, 135 put for February. I bought it back for $6.15, and then I rolled it to the March expiration, same 135 put, and I collected more than what I had to buy it back for, right? $6.15, and I collected $8.25. If we do some math real quick, I initially sold it for $1.50. When I rolled it, I had to buy it back for $6.15, which was a loss. That loss was $4.65 per contract. And then I rolled it to the next month for a credit of $8.25, which gives me an overall credit of $3.60 for this trade. So when you roll a trade, you're first trying to minimize your loss, then you're trying to break even, and then you're lastly trying to profit. So what this means is at the end of the trade, if I buy it back for more than $3.60, I will have lost money on the overall trade put together. All right, let's look at the trade tab real quick to see how I did this. I initially had the position in February 19th expiration, and I sold the 135 put, which is down here. So to roll this trade, I had to buy this back. Right now, it says it would be $4. And so if you want, you can do this together in the same transaction, or I usually do it separate because then each leg shows up separately in your transaction history in your activity tab here. But you can do it together, and doing it together will potentially make it more simple when you're doing the transaction, because then you'll see exactly if you're getting a credit or a debit. Because when you roll this, you want to get a credit, right? So right now this says a $4 debit for the 135 put in February 19th expiration window. So I have to buy that one back to close it. And then I come out to the next window here at the 50 days on March 19th. So when you roll it, you need to get at least $4. And when I did this, I actually could not get a better strike position. I had to I had to sell the same 135 put right here. Now today, one day later, in theory, I could actually roll this to a better strike at 130, and that's the best case scenario, is that you roll it for a credit and you roll it for a better strike. So if I did that, I would go here and I would sell this, and then look at that. It says my credit is 33 cents. So that would be perfect. Frankly, I wish I had this position yesterday, because now, instead of being at the 135, I'm now down at the 130, and I'm rolling it for a credit. However, I had to do the same 135 strike, which in some ways is fine because I gather a much larger credit, right? I gather 260 here instead of the other one was just 33 cents. So that will help push my break even farther out. Even though I don't get a better strike, instead of my break even being the original $1.50, it would now be $1.50 plus 260. So I guess that would push it out about $4 total. So that's pretty much it. It's pretty simple once you get the concept. Like I said, I usually do these transactions separately, so that means I would buy back the February 19th position first, and then I would sell the March 19th rolled position second. They'd be separate transactions. And then when you go to the activity tab, they are separate here, right? If you do them together, like I had it set up here, these are together, right? This is combined $2.60 with buying that back and selling this at the same time in one transaction. When you go to your activity tab, there would only be one line here that says credit 260, right? So then I'd just have a credit of 150 from February, and then I'd have another one single line that says credit of 260 for March. Either way, you get the same result. It's just how it shows up here in the itemized activity history, right? All right, let's take a look at the chart to see what's going on here. So I opened the trade here in early January on the 8th, And when I opened it, it was way up here around $145, $146. And then as you can see, this slowly sold off, slowly but surely. And then yesterday there was a big gap down, and that breached my break even, which I initially sold this for $1.50. So my break even would be $133.50, which is only right about here. This red line here is now my new break even, and my new break even is somewhere around $131.50. So even though I didn't get the better strike at 130, my break even pushes it almost out to the 130 strike. Not quite, because I collected a higher premium for the 135 position instead of the 130 position. Now hindsight is 2020, and when I opened this trade a few weeks ago, I was still in the kind of early phases of learning Elliott wave. And had I known then what I know now, I would not have gotten in this trade right here. And again, it's easy to say this in hindsight, but you'll see it makes a lot of sense here real quick. So if I zoom out a little bit, I'm going to turn this line off just to make everything easier to see. Turn that line off. All right, so I turned off basically everything that I don't need just to keep this as clean as possible. So if I'd known back then what I know now about Elliott waves, like I said, I would not have opened this up here. Because if I turn on the wave here, a minor Elliott wave, I opened this here when this was the correction from the wave 3 high to the wave 4 low. And assuming that yesterday this was the low of wave 4, it's now going to complete wave 5 to somewhere up in here. And so when I opened this trade here, I was actually buying at the peak of the minor correction here. Let's see, right there. If I zoom in there. So the Elliott wave comes up in 5 waves to 1, 2, 3, 4, 5. And then the correction for each individual correction here is an A, B, C, which is very common. It doesn't always have to do that, but that's what it did here. Guess I can turn this off to make it a little more clear. So that was the wave 3 high, then you corrected A, B, C down, and now it's taken off here. So assuming this is the bottom of the correction, which is the end of wave 4, this will now head higher to wave 5. And I determined this bottom point right here by using Fibonacci's. And so very commonly the correction here will be A, B, C, and C will equal either 1 or 1.618 is very common. And sure enough, right here yesterday, it was very close to that 1.618. It actually breached it just a little bit, but that's close enough. And so in theory, if this is the bottom, it's going to head higher now. Now it can go farther. It can go out to 2 times or even farther sometimes. And then how you determine where it's going to go, again, you use Fibonacci. All right, so I turn the bigger part back on. Let's zoom out here so we can see it. And so how you determine the 5th wave, one common way to do that is that wave 1 and wave 5 will be equal in size or very close to it. So you take the fib extension tool and you draw out, you start here at the bottom of wave 1. And so you go 0, 1, 2 to here, which is just the points for the Fibonacci. That's actually at wave 4. And so now this is drawing a Fibonacci extension where 0 to 1 is being projected from here up, right? So this is going from 0 to 1. And then if I zoom out here just a little bit more, 0 to 1. And then where wave 5 equals 1, the fib extension puts it up here at around $157.13. Because over here, this is 1, and that 1 is equal to wave 1 right here. So that's where my current projection is. And again, these are all just educated guesses, right? It's the Elliott wave theory, not the Elliott wave fact, right? So, but I really love the Elliott wave stuff because it is the only thing that really helps you project where price action will go in the future, right? All these other technical indicators, they're all lagging indicators, right? Like the MACD here and the RSI. Man, what just happened there with the chart? Like the MACD here and the RSI. These are all technically lagging indicators. And you can't tell from these indicators where the price might go up or down? Well, by using the Elliott wave theory, you can at least take a somewhat educated guess as to where things are going to go in the future, right? And so that's why I love Elliott wave, and it's crazy how accurate it can be sometimes. I mean, just the fact that this correction was almost exactly the 1.618, you think that's just coincidental, but it happens all the time. It's crazy. Anyways, so that's how I'm determining this 5-wave high. Hopefully I'm right, and this doesn't continue to correct farther down. It doesn't seem like it's going to, because one final thing here is there seems to be real strong support right around here, this 130 mark. It has acted as resistance or support several times in the past. I mean, you can see 1, 2, 3, 4. You could argue that's a 5, and then right now is the 6th time it has hit the 130 mark, either as support or resistance. So between that and the Elliott wave, I'm pretty confident here that this is going to move higher, at least in the short term. And really, that's all I need. I just need maybe a week or two for this to kind of stay even or move a little bit higher, and I'll get paid. All right, I think that covers everything. Trade often, trade small, and I'll catch you in the next video.